cap rate, NOI, OPEX, CapEx, cash flow, terms. What the hell do these things mean? I'm going to be going over the top 10 commercial real estate terms that I go through on a daily basis. First of all, what is underwriting? We want to find out if this is a good deal. We have to look at their financials, we have to look at the area, we have to try to calculate what we're going to need to do to get this property up and running and be a good deal for us and for our investors. The terms that we're going to be going over, I use every single day on buying properties, on selling properties, talking about properties. These are things that you absolutely have to know, and if you're doing a lot of deals or looking at a lot of deals, these are things that you are going to be talking about on a daily basis. Number one, NOI, net operating income. This is how much the property makes after all expenses. This does not include debt service or private money payments. The way you find this out is you just take, let's say a property brings in $1 million a year. Let's say the expenses are $600,000 a year. That means your NOI, your net operating income, is $400,000. NOI is one of the most important things because you can find out exactly how much money you're going to be making, not including your debt service. So if I were to go buy this thing cash, not have a bank loan or investors, and there's a net operating income of $400,000, I would be making $400,000 a year. Now the reason that NOI doesn't include debt service or private money is because everybody buys deals differently, gets different loans, different private money, they raise money differently. So the NOI is the baseline and then works its way down from there. Number two, cap rate. Cap rate is the capitalization rate. This is the rate of return on that NOI versus purchase price. So if an NOI on a property is $100,000 and I'm purchasing a property for $1 million, that means it's a 10% cap rate. If the NOI is only $50,000 and I'm buying the property for $1 million, that means the cap rate is 5%. There's two different cap rates, at least that I look at. Current cap rate is what is a property doing right now once I buy it. It could be negative, it could be 6%, it could be 20%. And then I also look at the market cap rate. The market cap rate is what I'm estimating the value to be in the future after I get this stabilized. So a mortgage broker or CoStar or just doing a little bit of research, you can find out what the market cap rate is, and that's what properties, once stabilized, are being evaluated at in that area for that type of product. So for example, I might buy a property that is an 8% cap rate, but properties in that area have a market cap rate, meaning they're selling at a 6% cap rate. So if I buy it at an 8, I can sell it at a 6 and make a couple bucks. Number three, CapEx. This is capital expenditures. This is just rehab. How much money are you planning to put into the property? Are you going to be putting in $1 million? Are you going to be putting in $2 million? Are you going to be putting in $10,000 per unit? Are you putting in $15,000 for half the units? And then $7,000 for the remaining units? This is just your overall rehab cost. This is super important. I see people go awry here a lot. Some people don't account for any rehab. They see a building, they go, oh, it doesn't need anything. One of the things that we do is we try to take care of every single thing that needs to be done out the gate at the start. It's easier for us to get the money to do the rehab up front than it is to, hey, we can take it out of cash flow, or let's only get half the money to do the rehab and then figure out the other half later down the road. I see a lot of people go in with, hey, it doesn't need anything, and then something breaks, or something that you kind of expected to break does break, and you need to go get the money to do that. So even if a property is spectacular, it's A-class, it needs nothing, so you think, we always at least account for a couple $1,000s, maybe $2,000 or $3,000 per unit, just in case something comes up when we buy a property. If something needs a lot of work, full turns, full exterior, maybe we're at $10 to $20 to $25,000 per unit. Number 4, OPEX, operating expenses. This is all of your expenses, again, not including your debt service. This is if I were to go buy this property cash, what expenses do I need to deal with? So this is going to be your taxes, your insurance, your utilities, your management, your payroll, and your utilities. Taxes, insurance, management, maintenance, payroll, utilities. Those are going to be your six big expenses. So typically for us, once a property is stabilized, we're running about 40% expenses. Now there's some times where it could be as low as maybe 35% when a lot of the utilities are maybe on the tenants, and it could be as high as maybe 50 or 55% expenses. That's if we're in an area where taxes are high or insurance is really high. Maybe you're on the coast somewhere and there's a lot of claims in the area and all the utilities are on the owner's name. So typically we're running around a 40% expense ratio, 40 to 45%, maybe as low as 35 and maybe as high as 55% expenses. Number 5, vacancy, okay? You'll have your actual vacancy. So, you look at a property, it's 10 units, 5 of them are vacant. That's a 50% vacancy rate. Now, there's also market vacancy. What that is us underwriting that there's always going to be a certain amount vacant. I cannot expect a property to be 100% occupied 100% of the time for the life that I own it, for 10, 15, 20 years. So I usually put in a 5 to 6% market vacancy factor. So I'm already planning for the property to be 5 or 6% vacant 100% of the time. Now, I'm hopefully not going to have it 5% vacant, 5, 6% vacant at all. Hopefully it's 98, 100% occupied. But at least I'm underwriting with that buffer that maybe something happens and 2, 3, 4 tenants move out, maybe 20 tenants move out, and I get down to that 92, 93, 94, 95% occupancy. But at least I'm planning for it. You have to plan for vacancy in anything that you buy, single family or multifamily. So I've just been talking about physical occupancy. There's also economic occupancy as well. I could have 100% occupancy at the property. I have a 100-unit building, there's 100 tenants, but economic occupancy, what if only 70% of those tenants are paying? So 2 totally very different things. We've bought properties before that had very high physical occupancy, but very low economic occupancy. And those are the tenants, I have to deal with those. I need to either get them on a payment plan, I need to either start them over from zero, or I'm going to have to go through the eviction process or cash for key situation and get them out. Halfway through the list, if you're enjoying this video, join our school community, Commercial Empire. It's awesome. It's totally free. That's where most of our team is interacting with you guys more than anywhere else. If you already know all this stuff, join Legacy Boardroom. Legacy Boardrooms are daily calls. It's a couple $100 a month. It's basically a board of directors every single day for your business. You have Monday acquisitions, Tuesday operations, Wednesday raising money, Thursday team building, HR, Friday we typically have a guest from somebody in our Legacy family mastermind. But every single day you can hop on and get the questions you have answered on how to scale your portfolio and how to scale your business. Number 6, cash flow. I know I briefly talked on this earlier, but your cash flow is actually how much money you're going to be making on a deal. You have your income. So let's say you have $1 million in income. You have your OPEX, your OPEX, your operating expenses. Let's say that's $400,000 because it's a 40% expense ratio. That leaves you with a $600,000 NOI. And then let's say our debt service every year, so our loan is $300,000. That leaves us with a cash flow of $300,000. That's actually how much money you're going to be taking home after everything, after all your expenses, after all your debt, after everything. Your cash flow is going to be $300,000. And that's the number that is most important. You need to figure out how much you want to be making off of this property. I usually do it on a per unit basis. If you're only cash flowing after everything $10 a unit a month, that's not very attractive. Now, if I'm cash flowing $200 per unit per month, or $500 per unit per month, that's a lot more attractive. So I usually go on a cash flow per unit per month basis, and I typically look for $100 to $300 per unit per month in cash flow. Number 7, rent roll. This is just a spreadsheet of who is in the unit. What type of unit it is. Is it a 2-bed, 1-bath? So I like to get the unit type. Is it occupied or is it vacant? What is the rent that they're paying? Are they paying any other fees, a parking fee, a pet fee, a utility reimbursement fee, their move-in date and move-out date. And then ideally it also has security deposits in there as well. Your rent roll is pretty much the first thing that you're going to look at whenever you're looking at a deal. And it's one of the easiest things for somebody to provide. Sometimes you get them on the back of the napkin or just somebody writing it out. Other times, people can usually just pull it from whatever management software that they're using. Number 8, T12. This is the second most important financial item that you can get. A T12 is a trailing 12. And what the trailing 12 is it is a month-by-month breakdown of all income and all expenses. Let's say it's June, and I request a T12. It is going to be May, so the previous month, back 12 months. So I should have 12 different columns of all the income and all the expenses. And what this is going to allow me to do is I'll be able to see month over month, are things getting better? Are things getting worse? Why were utilities so high in this month and so low in this month? I'll be able to see all the insurance charges, tax charges. Why in one month did you bring in $50,000, but in a totally different month you brought in $75,000, the next month you brought in $25,000. So it really paints a picture over the last 12 months, and you'll be able to pick out what discrepancies are in there and then ask about it. So if things are trending up, $20,000 one month, $25,000, $50,000, $100,000, and so on, things are trending up. If things are trending down, you have more questions to ask. And so that's going to give you your gross income. It's going to give you any additional income. It will show you all the expenses. It might include debt service. It might not, but it'll also show you your NOI, your net operating income as well. So that's the most important document that you can look at and be able to get a really, really, really good picture of what you're buying into and what levers you're going to be able to pull to get the income up and expenses down. Number 9, this is a term that I use a lot, more so internally, is blended cost of capital. This is the most important thing that I've learned over the last 10 years that I've been doing this stuff. If I would have really understood blended cost of capital 5, 6, 7 years ago, I would have done way more deals and way better deals than maybe I have. I'm not saying I've done a lot of bad deals, but if I knew how to pull different levers on blended cost of capital, my good deals would have been great. I used to look at deals one way. Did it fit this structure? No. I go buy a property for $10 million. I get a loan for $7 million, and I have to raise $3 million. I used to just look at that as 70% and 10%. Those are my options. That's what I'm going to get, or 65%, whatever. I did not know that I could adjust my blended cost of capital through raising money differently. I used to just look at 10% pref rate. Now if I can structure it, giving up a little bit more equity for a little bit less of a pref, if I can give up depreciation to get a little bit less of a pref payment, payment to my investors, so maybe I give them all the depreciation, but they lower their pref payment from 10% to 6%. Now, and my bank loan is at 7%. Now my blended cost of capital, 7% on the 7 million, 6% on the 3 million. My blended cost of capital is now, 6.5%. I know that math is a little wonky, but in the mid sixes, opposed to me getting my bank loan for 7% and my investor money at 10%, and then the blended would be 8.5%. So understanding the different levers you can pull from, the bank loan, your investors, get creative on how you can lower their pref payment. It's something I never even thought about. And then number 3, seller financing. The seller's money can always be cheaper than your bank money or your investor money. If a investor or a seller is willing to stay in it, 3%, they own this thing free and clear, and they'll seller finance 90% of it to me at 3% interest. That's way better than me getting a bank loan at 7% and raising the equity at 10%. Understanding what levers you can pull. This is something we talk about all the time in Legacy Boardroom and in Legacy Family. So, it's something that I've spent the last probably 3, 4, 5 years learning, and I've gotten pretty good at it. But really flexing that muscle and working that muscle on seller financing and terms and blended cost of capital. We've done a couple videos about seller financing, splitting up equity previously. If you want more info on that, there's a video somewhere around here. Go ahead and take a listen to that. Number 10, last but not least, probably my favorite item on this list, is just terms. Not terms as in terminology or vocab. Terms as in structuring a deal on your own accord and choosing how you want to structure this deal. This is something, again, that I didn't quite understand early on. You can make any offer you want, like shoot for the moon on all these deals. If I were to go to a seller and said, "Are you open to terms?" That would mean, hey, are you open to seller financing, basically, or creative financing? If they're open to terms, maybe they will seller finance 100% of it. Maybe they'll seller finance 80%, and they want me to bring 20% down, and basically they become the bank. Terms are the key right now. With high interest rates, asking if a seller is open to terms or creative financing, you can say that as well, is the key to doing really good deals right now. And when interest rates are amazing, when they're 3%, 4%, and you can get kind of debt like that, terms are even better, right? There's a lot of different benefits in there for the seller, taxes, capital gains, maybe you give them depreciation. There's all these different advantages for them, but terms are how all the best deals are getting done right now, or whether it's a loan assumption or seller financing or a combination of both. That is the key to doing really good deals right now. That's top 10 terms that I use every single day. If you're not in our school community, please go join it. It's Commercial Empire. It'll be linked in the description down below. If you want more ongoing daily support, check out Legacy Boardroom. And appreciate you guys.